Ever wondered how to really tell if a company is financially healthy? Well, today we're going to do just that. Think of it as a financial physical, and we're putting the water technology company AO Smith on the examination table to see what its numbers can tell us. So, how do you even start? How do you take a company's financial pulse? You don't need a fancy Wall Street degree. It's really just about knowing which numbers to look at and what they're trying to tell you. It's kind of like learning to read an X-ray or a lab report for a business. All right, clipboards out. We're about to put AO Smith under the microscope, looking at its key metrics one by one to see if we can piece together a complete diagnosis of its financial condition. Okay, first things first. Just like any checkup, you start with the vital signs, right? These are the big top-level numbers that give us a quick snapshot of the company's size and how it's been doing recently. So what's this big number? This is the company's market cap. Basically, it's the total price tag if you wanted to buy every single share of the company. Right now, that's just under $9 billion. It gives us a sense of scale, how big this player is in the market. And here we have the last closing stock price. This is what the market, all the buyers and sellers out there, agreed one piece of the company was worth at the end of the day. This is our baseline. Now, this number shows us how the stock's been doing lately. It's actually down about 3% since the start of the year. This gives us a quick look at the recent mood around the stock, but, and this is important, it doesn't tell us the whole story about the actual business. Okay, so the stock price took a little dip, but what does that really mean for the business behind it? Let's dig deeper, past the price, and measure the company's real strength. Is it growing? And more importantly, is it actually making good money from that growth?
Oh, okay. Now this is where it gets really interesting. Look at this. Revenue, that's the total cash coming in the door. It's been growing, but kind of slowly. But then look at the net income. That's the actual profit left after all the bills are paid. It has absolutely surged, over 32% a year for the last 3 years. So what does this tell us? It tells us AO Smith isn't just selling more stuff. They're getting way, way better at turning those sales into cold, hard profit.
And that leads us to one of my favorite metrics for judging a company's quality. It's called return on invested capital, or ROIC. It asks a simple question. For every dollar the company puts back into its business, how much profit does it spit out on the other side? It's a huge indicator of efficiency. And would you look at that? The chart just spills it out for us. AO Smith's current ROIC is beating its own track record. It's higher than both its 3-year and 5-year averages. That is a fantastic sign. It shows us the company is actually getting more efficient and more profitable as time goes on. So, the business is strong, but is the stock a good deal? That's the million-dollar question, right? This is where the PE ratio comes in. It's just a simple way to see how much investors are willing to pay for the company's profits. And right now, AO Smith's PE is way down, over 27% lower than its recent average. What could that mean? Well, it might suggest that even though the business is performing really well, the stock itself could be on sale compared to where it's been. A company that's this profitable often likes to share the wealth with its owners, the shareholders. And that brings us to our next stop, dividends. How a company handles its dividends tells you a lot about how stable it is and how confident management is about the future. 32. Just let that sink in. For 32 consecutive years, AO Smith has given its shareholders a raise by increasing its dividend. Wow, that kind of track record just screams reliability and good management. So can they actually afford to be so generous? Oh yeah. This chart shows us they're only using about 36% of their free cash flow. That's the real spendable cash the business generates to pay out those dividends. That leaves the other 64%, a huge chunk, to plow right back into the business to keep growing. And it's not like the dividend is just sitting there either. It's growing. We're talking an average growth rate of almost 7% a year for the last 5 years. That means those payments to shareholders aren't just reliable, they're consistently beating inflation. All right, the moment of truth. We've checked the vitals, we've measured its strength, we've looked at its history. Now it's time to put all the pieces together and figure out our final diagnosis. What's the bottom line on this company's valuation? But before we get to the final number, we have to talk about one of the most important ideas in investing, the margin of safety. All this is really is a buffer. It's the gap between what you pay for a stock and what your homework says it's actually worth. The bigger that gap, the more room you have for error, and the lower your risk. So with all that in mind, after this whole financial checkup, what's the final verdict for AO Smith? Okay, so when you run the numbers using a pretty standard analysis, the fair value for A.O. Smith stock comes out to over $113. Now, this is just an estimate, of course, but it's an estimate of what each share might truly be worth based on the health of the underlying business. And that brings us to our final number. If the stock is trading around 64 bucks, but our estimate of its true value is over 113, well, that gives us a margin of safety of more than 43%. So, to use our little checkup analogy, the diagnosis suggests this patient might be in much, much better health than its current market price would have you believe. So, we've looked at everything, right? From growth and profits to dividends and value. It really makes you think. And it leaves us with one final question for you. When you're doing your own financial checkup on a company, what's the single most important vital sign you look for? What's your go-to metric?